Business Solutions articles. Financial Management. Cash Flow Analysis, Basics, Benefits and How to Do It. Lisa Swartz. Lisa Swartz, Sister Director of Global Product Marketing, September 3, 2020. Cash Flow Analysis. Cash flow is the amount of cash and cash equivalents, such as securities, that a business generates or spends over a set time period. Cash on hand determines a company's runway. The more cash on hand and the lower the cash burn rate, the more room a business has to maneuver and, normally, the higher its valuation. Cash flow differs from profit. Cash flow refers to the money that flows in and out of your business. Profit, however, is the money you have after deducting your business expenses from overall revenue. Video, what is cash flow analysis? Top. What is cash flow analysis? There are three cash flow types that companies should track and analyze to determine liquidity and solvency of the business: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. All three are included in a company's cash flow statement. In conducting a cash flow analysis, businesses correlate line items in those three cash flow categories to see where money is coming in, and where it's going out. From this they can draw conclusions about the current state of the business. Depending on the type of cash flow, bringing in money in isn't necessary. Depending on the type of cash flow, bringing in money in isn't necessarily a good thing. Cash from operating activities represents cash received from customers less the amount spent on operating expenses. In this bucket are annual, recurring expenses such as salaries, utilities, supplies, and rent. Investing activities reflect funds spent on fixed assets and financial instruments. These are long-term, or capital investments, and include property, assets in a plant, or the purchase of stock or securities of another company. Financing cash flow is funding that comes from a company's owners, investors, and creditors. It is classified as debt, equity, and dividend transactions on the cash flow statement. Why is cash flow analysis important? A cash flow analysis determines a company's working capital, the amount of money available to run business operations and complete transactions. That is calculated as current assets, cash or near cash assets, like notes receivable, minus current liabilities, liabilities due during the upcoming accounting period. Analysis of working capital provides a snapshot of the liquidity of the business. Number 1. Cloud accounting software. Free product tour. How do you perform cash flow analysis? Top. To perform a cash flow analysis, you must first prepare operating, investing, and financing cash flow statements. Generally, the finance team uses the company's accounting software to generate these statements. Alternately, there are a number of free templates available. Preparing a cash flow statement. Let's first look at preparing the operating cash flow statement. The line items that are factored into the company's net income and are included on the company's operating cash flow statement include but are not limited to: cash received from sales